Hello Proponomics people, and welcome to the Macro Blast from the 19th of February 2024. Now today's is in the form of a summary of yesterday's Sunday supplement, which this week I called Recession, What Recession? So you can probably tell from the title I'm a little bit sceptical about the notion of this recession. Obviously it's a technical thing, so the UK has slipped into a recession on the current numbers, which were from quarter 3 and quarter 4 of 2023. And I say currently because quarter 3 particularly was a drop of 0.1% in GDP. So I learned last week myself that these things can be revised for up to 3 years after the event. And you might remember that last year we had some pretty significant changes to some of the 2021 figures, which poured a lot of doubt on the fact of whether the economy had actually contracted or not, and meant that the UK economy had done a lot better than was expected. But this weekend, one of the things that I did was really got into the detail and asked, well, what really truly matters? Is it GDP, which tends to get a lot of criticism? That is the measure of the recession. Has GDP gone up or down? And it's those two contractions in a row that mean we've got that technical recession. I saw some commentators saying that GDP per capita would be a better measure of how people are getting on. And generally speaking, I would agree with that versus GDP. So remember, both of those figures are in real terms, so they're adjusted for inflation to see if there's real growth rather than just inflation-led growth, of course. But you can't really criticise GDP on one hand and then on the other hand say GDP per capita is a good measure. It might be a better measure than GDP, but if GDP in itself is the problem in the first place, for example, if we have a massive war, borrow lots of money, lots of buildings and people and military equipment is destroyed and then gets replaced, obviously the people don't necessarily get directly replaced, but the physical things do, then GDP goes up significantly. And that's obviously not a very good measure or yardstick of proper and true economic growth. Apart from anything else, you'd expect there to be a debt issue. So you might have some kind of notion of a debt adjusted figure for growth, which would be quite difficult to conceptualise. But I prefer the Office for National Statistics RHDI it's called, so it's real household disposable income, so real meaning adjusted for inflation, household meaning the individual household units that we look at on a macroeconomic basis. So the average, for example, the average migrant household is only 1.25 people, which is symptomatic of the fact that people quite often come to the UK, quite often male, quite often of younger working age, in order to find a better economic future. Whereas you might remember back in the 90s or 80s when they talked a lot about 2.4 children. The point is the average household was quite a lot larger than it is today. Of course, fewer people are married or staying married, more people live independently, and the average household number has shrunk. And some people actually frame the housing crisis from the perspective that actually it's not really the number of homes that the problem, it's the fact that the number of people, average people per household, is going downwards. I'm not sure how true that would be these days if we had a really true metric, because you might recall a few weeks ago I looked at the fact that with 1.3 million net migrants it was quite difficult to understand where they had all gone apart from anything else, and I ended up concluding perhaps around about 650,000 people were staying with friends, family, distant family, sofa surfing, things like that. Obviously you might have seen that temporary accommodation figures have exploded. Again, I think we're probably having the wrong argument around all of that, because I suspect around 50,000 people were added to the temporary accommodation figures last year when there was such pressure on the asylum system that people were rubber stamped, approved, and then ultimately went off into the ether with a ridiculous 7 days to find a permanent tenancy, which of course they wouldn't be able to do. So it ceases being a Home Office problem and then it becomes a local authority problem. And of course the local authority problem is now so large that central governments had to intervene by providing funds for temporary accommodation. So it's simply moving people around, numbers in the system, and very, very typical of what happens in the public sector, unfortunately. But I looked in the supplement this week at the employment and unemployment figures. So number of people actually employed, 75% of the 16 to 65s, which is still the measure that the ONS use, even though retirement age has changed obviously over the past few years. That number was up to about 76.2 at its height before the pandemic, but unemployment stays low at 3.8 and is actually going downwards, trending downwards, not upwards, which is a very non-recessionary thing to see, although the timing isn't always perfect, of course. There are a number of theories around this. One of them is labour hoarding, which happened quite a lot during the pandemic. We had the furlough scheme. Actually, the USA is being accused of labour hoarding at the moment, and this is symptomatic of a tight labour market. When it's hard to get replacements for people, you're more likely to hold on to people because recruitment is so hard. And there is some logic in that, of course. But unemployment low, but employment a little bit lower than it was. Why? Because economic inactivity is still high, primarily down to long-term sickness increasing so much, of course. And that's a pandemic-sponsored event, of course, not necessarily lots that could be done, but of course a functioning healthcare service and waiting lists falling, not rising, would be a start of sorting that out. Inflation sideways, so CPI stayed at 4 instead of 4.2, which was the forecast. Services inflation was up. Wage growth is still either side of 6%, depending on which measure you use, with or without bonuses. That is not consistent with a 2% inflation target, and it needs to keep on coming down, of course. Consumer expectations around inflation are back up to around 3.9% for this year. They were down at 3.5%. Expectations are important, and I wouldn't be surprised if the expectations were pretty close. My own expectations are around about 4% for the course of the year, and I think, again, if we look across to the US, they're still battling inflation above their target, even though their wage growth has calmed down quite a lot more than the UK wage growth. And then GDP itself, well, already discussed really in terms of where it's gone, so down 0.3 in the final quarter of last year. So we're looking at a contraction, but 2023 as a rule, 0.1% growth, that's the current figure over the whole of the year. Stagflation, which is one of the eventualities, the most likely eventuality that I talked about when the pandemic was well underway and we were coming to the end of it. There were lots of potential options, but inflation you'd expect to be sticky and difficult. And then bond yields closed last week at 4.006%, so psychologically just above that 4% yield, trading near towards the top of where I think the range should be at the moment. But of course that range could expand if we have some more inflationary news and inflation looks like it's stronger for longer, because if inflation is, and this is what I've been arguing for the last few years, then of course interest rates being more elevated will also be stronger for longer. So in summary, look at the real household disposable income. The housing market looks in relatively rude health, with lots of good news around listings and sales, and it's looking a lot healthier than 2023, but of course 2023 has been a particularly difficult year, with around 5,000 letting agency and estate agency branches closing their doors permanently. Now that's branches, that's not necessarily businesses going out of business. They might just be trying to save money, be going online, people going self-employed model, things like that. Of course that's possible, but much fewer transactions than the years before, and this is part of what people are calling for in terms of stamp duty holidays and all the rest of it. And of course the large house builders are calling for stamp duty holidays because it's massively within their self-interest. However, the real conclusion is this currently doesn't look like a recession. It looks like a technical recession we're already out of. You could look more at the US model of ways of doing it, when they have a panel of economists who decide whether it's really a recession or not. They don't just accept the 2 quarters of negative growth. The last 5 UK recessions that have been indicated by that contraction have been much more significant and have averaged a 5% drop in GDP as it goes. Currently we're at minus 0.5% or around there, so 1/10 of that. It could be a technical recession, but there could also be a chance of a double dip, of course. So there's all sorts of conclusions you could potentially draw. We need to be cautious about which ones we do draw. I think at the moment things look positive and it doesn't look like a particularly recessionary environment. So, as I always say in the supplement, it's time to keep calm and carry on. Thanks, folks.